you to focus on Liberia. Today is Saturday, and it is our business and economic forum that we call FOL Marketplace. Here at FOL Marketplace, we discuss issue of business and economics. And in today's edition of our show, we will be discussing COVID-19 impact and outlook on the commercial markets in the United States. And it is my pleasure to welcome you to the show, folks. As we always ask you, so as you have joined us, please hit that share button on our behalf so that not just you alone, but your friends as well will be able to benefit from this conversation we are about to have about the impact of COVID-19 on the entire commercial credit market. I don't know, some of you might not know what is credit market, but we have a gentleman here as our guest. He's Gabriel, and Gabriel is here to provide his expert understanding on what is commercial credit market, and that's why we are here. And again, as I said, I'm happy to be here. We want to welcome you to the show. This is Focus on Liberia, and this is FOL Marketplace. In the house with me, I have my partner, Mr. William King. Mr. King, welcome to Focus on Liberia.
Thank you, Anthony. Thank you so much for having me once again. We're here another Saturday, another edition of Focus on Liberia Marketplace. Like my fellow said, we're going to be looking at commercial markets, the commercial credit market. What's going on in there? Is it in a desert or is it a good time, bad time? Where do we stand? And we're so thankful for our guest to join us, Gabriel, who will be talking a little bit more about himself. I'll let him introduce himself and then I'll come back to our disclaimer. Gabriel?
Hey guys, thank you for getting me on the show. I appreciate being on the show. I hope to learn as much from you guys as we will be discussing about commercial market. I followed the program for about 2 months, so I like what you guys are doing so far. So continue to do what you do, and it's a pleasure to be on the show. Thank you.
Thank you so much. Thank you, Gabriel. Now for our disclaimer, and then Anthony, I'm going to hand it back over to you because we got a lot to cover. So the content is for informational purpose only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained on our media or written documents constitutes a solicitation, recommendation, endorsement, or offer by Focus on Liberia or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such media material may be shared. All content on the site is information of a general nature and does not address the circumstances or any particular individual entity. Nothing in this media constitutes professional or financial advice, nor does any information on a platform constitute a comprehensive or complete statement of the matters discussed or the law relating thereto. Thank you, Anthony, and back to you.
Thank you, William, and I'm happy to be with you in this conversation about COVID-19 impact and outlook on the commercial credit market in the United States. Folks in cyberspace, again, we can welcome you enough to this very important conversation. You all have gone to the bank to ask for that personal loan, that auto loan, and sometimes that mortgage loan, and we want to know how things are. And we also want to know why is it that sometimes when you show up, they ask you, you have to put some money down as down payment. And there are times sometimes they say, oh, you don't have to put anything down, you're good. Why is that? When you borrow money from the bank, we want to know, do you really benefit as the borrower or is the bank that is benefiting more? Hey, who we better have to provide their expert opinion and understanding on the issue than our guest, Gabriel Carter. Mr. Carter, again, I want to welcome you to our program. Please say a brief little about yourself, just something small about yourself so that our audience will know who they have as our guest. Thank you.
Thank you. Both again, and. I don't want to go too much detail about myself. I don't like talking about myself.
Right.
But just a little abstract bio about myself. I've been in banking for about, I would say, the last 5 years. I've started in every division of the bank. I started in retail, move on to credit. From credit, I transitioned to compliance and went back to operations. From operation, I came back into the credit risk side, which is currently what I do as a portfolio manager / underwriter. I got into banking about 5 years, as I said, 5 years ago, right after graduate school when I got my master's. It was a personal decision to get in. I could have gone into, management consulting, but I think there was a niche to really understand banking and what it is.
Right.
So I got in 5 years ago. Currently, I'm a assistant vice president. I manage about 200 million portfolio. I underwrite about 100 million portfolio a year. For a mid-sized bank, we're not too big, we're not too small. So we consider ourselves a mid-sized bank. And I've been doing that for the last 5 years. So that's, pretty much about me. As I said, I don't want to go too much in details about myself, but that's practically what I do right now.
Thank
So
you.
thank
I
you.
think you did excellent. Giving us a little abstract by yourself. I
Yeah,
myself, William as well. It's always a difficult thing sometimes to blow your own horn. Maybe it's better for those on the outside to see what you do and be able to tell it in your own words. Hey, folks in cyberspace, let us talk money. Money is important. This time around, we're talking about credit. It's a kind of money. You don't have that money right now, but you are qualified for it. Why are you qualified? Do you know? Anyway, I have my man here, William Benakin. William, get us started with this commercial credit marketing.
Right. So I think Gabriel just kind of warm us up a little bit. You talking about the credit market. Anthony brought up something from the retail side, right? From I'm the man walking in. And last week we had someone on that spoke about more the personal dynamic relationship.
Okay.
But of course, creditors, Visa, MasterCard, some of those guys that come to us to issue us those credit cards or different entities, the
Absolutely.
assumption is that they have to do it with you guys in the back in mind. So tell me, where do you fit in with in the commercial credit space?
So commercial credit is we specifically deal with businesses. That's it.
Okay.
So if you talk about a line of credit, a term loan, commercial mortgage, I think one of you guys mentioned it earlier. It's everything that has to do with businesses. That's how we deal with it. From your mom and pop stores to the multinational corporation. So that's practically what commercial credit is. The market itself is a very big market where all the banks in the U.S., the market size is about $682 billion market, right?
Okay.
And that JP Morgan, Bank of America, Wells Fargo, you name it, that's the entire market, commercial, banking market right there. So that's practically on basically what we do. We're specifically on the business side. It has nothing to do with the consumer side of things. So that's
what is going on as most of us we might be in the small business space, and let me give you a few examples what I mean.
Right.
We may run a small supermarket. We may run a franchise. We may run a cleaning service. We may do shipping, import, export, and so forth.
Right.
Right now, with everything going on, what is that looking like as far as constriction? Have you seen the market being constricted? You've been, I'm sure this year you had some projections. Right now, what is that looking like?
Right. So before we get into that, I'd like to give you a subset of the market. before we got into what actually happened, the COVID-19, because I think the economy, right, is a function of the banking sector. So what happened in the economy transition or translate into what we do in the banking sector, right? And that also translate into how businesses react and down to how consumer like you and I actually behave to, in the banking sector. So before we even got to this, right, we had the longest expansion in the U.S. economy, probably on history, right? From 2009 to 2019, right? At that, for 113 months straight, we had job growth, right? And that is massive. That's a lot of expansion, right? We've never had that lot of expansion anytime before, right? So the economy itself was growing about 2.3, or in some quarters we had, I would say about 3.5%. So that was massive. In addition to that, I think when Trump came in, we had the new tax cut, right? It took corporation tax from 35%, it dropped it down to 21%. So what that did, whether you're a mom and pop that runs just two-man business, or to 3 million, not 3 million, but 20,000 employees, right? It put a lot of money back in your pocket. So that money is going back into businesses. What it actually end up doing, it created a lot of jobs, right? So on the subset, on the back end, I think the economy was doing pretty well. I think the only thing that we were worried about before was, corporate debt, in addition to all these businesses doing well, because the money was cheap then. So a lot of businesses were taking on loans. They were just taking on loans because the money is cheap. You just want to hold as much money as you can and hold on to it, because you don't want to take on money when it's, the interest rate is too high. So that was one of the problems that we're running into, right? So that actually translates into, exactly what was happening in the economy. Now, to go back to your question of what's happening in the market, what projection that we made, right?
Yeah.
We knew, I don't want to say certainly that we knew this was coming, but we knew sometime last year that we're headed for recession, right?
Gabriel.
Okay.
So, yeah.
Gabriel.
Yeah.
I want us to start with basic.
Right.
We will get to how COVID-19 has impacted the entire commercial credit market and how it's looking right now. But let's start with
you want me?
Yeah, hold on. Let's start with the basic. When I say basic, first of all, let us understand, because I'm not a commercial guy, I'm not a business guy, and many of our listeners are not. So let us first define what our topic is. What is commercial credit? And also commercial credit market. Let's get that understanding first. What is it?
Let me do that right for you right now. Okay. So as I said earlier, so commercial credit are basically your small business, whether it's for your mom and pop business to the giant corporation.
Okay.
It has to do everything with businesses. Whether you're taking out a loan to start a business, or you're borrowing money for, a line of credit for business. Say, I just want to sit on this money. It's going to be there just in case I need it. My business can tap into it. It's going to be there. Or your business is buying a property, you expand it, you want to buy another property somewhere, you just come and say, hey, I need a commercial mortgage. That's pretty much what commercial credit is. We do small businesses from, as I said, mom and pop to giant corporation. It covers that entire segment. And again, as I said before, the size is about 682 billion, the entire U.S. market right now. So that's practically what commercial credit is.
So Gabriel, for the better understanding of my listeners, when you use your professional language, try to break it down for my people and for me. Is that money? When you say commercial credit, is that money talking about money that can be given to businesses for them to, expound?
Right, that is money, right? So if you come in, let me just, you're right. And maybe I should apologize for not breaking it down, right? So that is money, right? So let's say if you come into the bank, you run in, ancillary, real estate services, right? You have, let's say, about 5 employees there, and you say, you know what? I've been operating in this location. I think there's another location that I think we should move into because we're expanding.
Right.
And you come to the bank, you come to us, you say, hey, guys, I need a loan, right? Those are the kind of businesses we deal with, right?
Yeah.
That's from, like I said, average consumer business, you and I, to the giant corporation. So that's practically what commercial credit is. It has to do everything with business. No personal loans, or we don't even do personal mortgages. We just do everything commercial. Yeah.
Okay.
Yeah.
Thank you. At least I got some better understanding. I think my folks there are happy.
And you're right. I should have done a better job at breaking it down in pieces.
Thank you. Thank you. Right. So let's walk around the process. Explain to me and William the process. Okay. Let's say somebody running a little bakery shows up at your bank, say, hey, I had a bakery, we're doing well. We want to put another one in California because they got big box down there. So walk me through the process, the application process, the approval process. What are the things you're looking at to give the approval?
Perfect. That is a great question. I appreciate you asking that question. Because I think sometimes you want to talk to people about businesses, and they think sometimes they come to apply for loan. You look at the application, you look at everything, and then you tell them no. They think you're just doing it because you don't like them. But no, there are rules we follow, right? So could be anybody could learn from this thing, from anybody on the show here right now. If you wanted to get into credit, there's we call it the 5 C's of credit, right? Okay. So there's 5 C's of credit. There's character, right? Your character. So we look into you. What is your credit score, right? How is this person? How you good? Are you paying you back your loans, right? What is your credit score? So that's the character. The next thing we look at capacity, right? The ability for your business to be able to service that debt. So let's say if you're taking out 100,000, are you making enough to be able to pay back that loan, right? Or are you making enough to be able to make your monthly payment every month on that loan? Or do we have to come chasing after you for it? So we look at in order to determine that, we ask for at least 2 years or 3 years of financial record. So your income statement, your balance sheets, and we run what's called, analysis, right? To determine the cash flow. Right. So that's the capacity. Then the next thing we look at is capital, right? Okay. Do you have enough assets on your balance sheets, or are you leveraged? Leverage means that you're so much in debt that the least may say something happened to your business, you can go out of you can file for bankruptcy. Right. So we look at those things. We look at your leverage. We look at your liquidity. Liquidity means within 6 months or a year, can you sell something, or do you have enough assets on your balance sheet to pay back this loan? So that's the capital part of it. The biggest piece of it, which is the security piece of it, is how you're going to secure this loan, right? We look at your collateral. Collateral is, if I'm giving you 100,000, what are you giving me in return for me to sit on in case that loan go bad that I can collect on? The general collateral out there that we use is called all business assets. So it could mean like your furniture in your businesses, the computer in your businesses. It could mean if you want, you can even take a second mortgage on your home, because if you don't have that, you can take a second mortgage on your home. We can take a second mortgage and sit on that as collateral, right? So that's the 4th C in the 5 C's of credit. The last one is a condition. Of course, what is the purpose? Why are you borrowing that money? What are you going to use it for? Also the interest rate that we're going to charge on it, so that's the basic. Like if somebody were to get into commercial credit, right? That's the industry you want to pursue or anything like that, that's the basic things you need to know to be able to sex an application for a borrower. Yeah.
Thank you. You go, William. He talked about the 5 C's. William, you are a business guy. That place there is rich. Let's talk about it. William, you go.
Well, definitely. Gabriel, you're on the road. Those 5 C's definitely important wherever you are in the U.S. Right? No matter how rich you are, when you come in there, you walk into the door. When we pull off the veil, we see the real story, and so I think that's very, very, very critical. Something else that you mentioned was the process. When you look at someone now that's walking in now compared to post COVID-19, compared to the situation with the incident with the George Floyd incidents,
Right.
in your work right now, have you guys had like and you don't have to be specific, but have you guys called like a meeting and say, hey, we need to either adjust certain levers up or down?
That's another great question. Is you guys, I don't know if you actually read my notes. This is impressive. So yes, we do. So during this whole pandemic when it happened, right? Every bank right now that is in the United States or even around the world, right? Every bank has an appetite, credit appetite, right? What that means, how much the appetite means how much risk you can take, right?
How much money you want to lend?
How much money you want to
Yeah.
lend, how much risk you can take on certain transaction, how much exposure you want to go into certain
Yeah.
industry, right? So that's the appetite. So when this whole COVID-19 happened, we immediately, like every bank, you have to readjust your credit policy, right? You can't be as liberal as you used to be anymore, right? Right now, there are some industry you don't even want to look at. Like when they come borrow money, because the condition that we're in right now, you don't even want to look at it, right? So that is exactly what's happening right now. Banks are actually adjusting their credit policy. Matter of fact, if you look at banks right now, they're reviewing their line of credit. So let's say if I expose you 100 million, right? And I know your industry is in one of the risky industry. I'm going to review that 100 million right now. If I risk rated at the initial stages for let's say 5 or 4, and I know right now your business isn't doing so well, I can downgrade that risk rating, right?
Airline suppliers. So, for example, we might say, okay, I supply a lot of the food to airlines for the flying, or I supply maybe the nuts and bolts, right? I supply engine parts to our airline.
Right.
I normally have a good relationship with them, but right now I'm pretty much I'm in this situation, right? So you're looking at me, no. So I think in certain area where it gets dry, but I think go ahead. You had a thought. So the next thing I want you to add to that thought is then how does a bank stay open if it's not lending?
No, we are lending, but we are we scrutinize every deal, every transaction nowadays, right? Before it wasn't as we didn't have that much scrutiny on transaction, but now every deal we put you through, we put you through the ringer, right? We will look at everything back and forth, digging even deeper than we used to. That's not to say we're not lending; we are lending, but the credit, the policy is just tighter. And I think the reason why we're still lending to, and I think I wanted to get into this because when this whole pandemic happened, the Fed kind of loosened up their what's called reserve requirement for banks, right? So that gives banks a little bit of leeway to continue lending, right? So we are lending. So it's not to say we're not lending, but we just scrutinize transaction a little more than we used to do. Yeah.
Okay.
Thank you. Thank you. Again, folks in cyberspace, you are watching Focus on Liberia. This is FOL Marketplace. It's a business and economic forum where we discuss issue of business and economics. And today we are talking about the impact of COVID-19 on the commercial credit market. We have with us Gabriel, and Gabriel is a business guy in the area of this whole credit, commercial credit thing. And we are talking to him for him to share with us his professional understanding of how these things worked. Earlier, you talked about the Trump tax cut, how it was reduced to, was it 25% from 35?
From 35 to 21.
To 21. That was huge. And you said earlier,
Massive.
that alone put a huge amount of money in the hands of the business people, the corporation.
Yeah.
Is there any way you can explain to an average person, even though they was directed at the cooperation or into the entire commercial market, how does it impact positively the ordinary man who is trying to get a loan?
Um, I don't directly. It doesn't. I won't say that it impacts the average person getting a loan.
Mhm.
So what it did, what it did, it just gives bank more money back
Mhm.
in their pocket. Not just banks, businesses in general, right?
Right.
If you're filing taxes, you're paying 35%, and somebody come to you and say, hey, you're not paying 21%, you'll be excited, right? That's money right now in your pocket. Now, for businesses, I think some banks were even giving back their employee bonuses. I know there's a bank that was giving back 1,000 to every employees, right? Because they had so much money, they felt, that was great, right?
Right.
But as far as that impacting consumer directly, I think the only way it impacted consumer was that it kind of boosts the hiring rate, right? So
Mhm.
sometime between 2016, after 2018, the hiring process actually increased. That's because these businesses had a lot of money on their balance sheets now or on their
Right.
books. They
Mhm.
could either invest or hire, more talented, more talent to actually to bring on board. But as far as somebody like you and I going into the bank and asking for money, it didn't really impact that directly. I think the only thing that actually helped the average consumer like you and I was the fact that during that time money was cheap, right? So the interest rate was low. Like we've been in that low interest rate environment for a long time, and it was becoming a problem, right? And that's why the Fed started raising interest rate 3 times last year, because they wanted to catch up so we don't have an inflation problem. But I think the only thing that was benefiting us is that low interest rate environment. So
And
that's
I also want to know
yeah.
the whole commercial credit market uh, got a huge incentive with the tax cut. So an Irish person like me would think that, okay, that means the bank's going to reduce the interest rate on loans so that
Yeah,
just as they are being impacted positively,
right,
I too will be impacted positively. Did that
right.
happen at all? And if it did
That
not,
would that would
why
that
why they didn't do that?
right. That would be the logical thing you would think, right? But
Right.
that's not how the process operate. I think the reason why it didn't happen in the banking sector is because, as I said before,
Mhm.
um, what we do in lending is controlled by the interest rate that is set by the Fed, right? The economy, what's happening in the economy, right?
Right.
Um, I think things like that happening, it just impact employee directly. People that are working for those businesses. That's how
Right.
those were the people that were impacted. I think those were the people that benefited. As I said before, some banks gave their employees, money, bonuses. But as far as that determining what you get for on interest rate for a loan that you're applying for, it didn't really have any impact on that. Yeah.
Okay. Finally, before William comes in, now that you have given us a unique sense of how things were,
Right.
then COVID-19 landed on us, unexpected, for
Hmm.
ordinary people like us. How is it impacting the entire commercial credit industry? And also
Yeah.
share with us, looking at things now in the future. You think things are picking up and we should, try to be hopeful a little bit?
All right. So first, let me answer your question. How it impacted, your question is how is it impacting the commercial market, right?
Yeah. Uh-huh.
Right.
Yeah.
Okay. So right now, even banks themselves, right? We
Yeah.
went into this well capitalized. Well capitalized means we had a lot of money on our books going into this coronavirus pandemic, right?
Hmm.
But we're gonna come out of it with a lot of bruises, right? What I mean is that we have this money going in, but because there's so much expenses that's happening right now in the banking sector or in any sector as a whole, but we don't have the revenue coming in to actually make up for that. You're gonna just keep spending money without making having enough money coming in. So that's how this is actually impacting the banking sector right now. Not just the banking sector, businesses as a whole, right? businesses that had even liquidity, right? That liquidity meaning they had enough money saved up to, going into this industry. Now, it depends how much money you have saved, whether you had 3 months, 4 months, or 7 months liquidity to sustain you through this. That's going to depend how you come out of it, right? Now, if you've gone into this COVID-19 with just 3 months of liquidity to survive, and we go beyond 3 months, the chances of you coming out of this is slim. I mean, by the time we go over this thing, you'll probably be bankrupt, right? So again, the more liquid you were going into this, the better your chances are of coming out of this, right? Now, as far as what's happening, the recovery, what we can expect, a lot of people are actually predicting that this is going to be a V recovery. So V recovery, people are thinking we're up here, we'll come down, which we're already down right now. Right. And once the economy open back up, we're going to start going right back up, right? Things going to start picking up instantaneously. I think, to be honest with you, that is very optimistic, and I like people to be optimistic, right? But that's not the reality, right? In order for this thing for us to come out of this thing, right? It's gonna be contingent upon having a vaccine, right? Not only that, you're gonna have the consumer confidence, right? Because this thing happened, a lot of people are not spending anymore. Even though the Fed is putting money back in people's pocket with this stimulus check, right. Even also in the payroll protection, where employers are still paying their employees even though these people aren't working, right? You're gonna have you need consumer to keep spending, right? To keep to get the economy going again, right? You need a vaccine, right? So we're gonna stay at this level for a little bit of time, and I think probably the next 18 to 3 years before we can come out of this, or before even going back to where we used to be. So that's exactly what I think is happening in the market right now. And this is what I think is going to be our reality for the next 18 to 3 years.
Well,
18 months to 3 years. Yeah.
Well,
yeah.
Well, you are on mute. Again, folks, in cyberspace, this is Focus on Liberia, and we are discussing COVID-19 impact on the commercial credit market and how things are looking. And we have in studio as guest Mr. Gabriel Carter. Let's come to you, Mr. King.
Yes. Gabriel, do you see some adjustments happening in terms of the level of lending you guys do? Will you do more smaller lending, or do you think you're gonna get into some bigger lendings at the very beginning? What type of companies do you think you might see?
You mean during or after?
After this whole COVID-19.
So as I said before, even during the pandemic,
in terms of number value, will you be are you going to be looking at in terms of when you're looking at small businesses, will it be mostly like $1 million below, or do you think there's going to be adjustments in that space, because a lot of companies are going down at the higher value?
Right. So again, I don't think it doesn't depend on adjusting. It depends on the kind of industry you're lending to. So I think I mentioned earlier that if it's actually an industry that is considered essential, right? So industry that are, we consider essential industry that are open during this whole pandemic, right? There's a more favorable, way of, lending to them, right? Whereas if you had if this is an industry that is, that isn't essential, right? You kind of, this is when you actually revert back to the, your lending policy. Now, is this something that you want to, depending on how much money they're asking for, again, it all goes back to the 5 C's of credit. Not only the 5 C's of credit, you're now looking at the economics of what's going to happen. How do you think this business is going to succeed after this coronavirus? How are they doing right now? And what plan do they have in place to actually rebound after this coronavirus? So those are the type of deeper questions beyond the 5 C's of credit that you ask. What are your plans for the future? How do you even have some contracts on your books that you're going to go back to? How much liquidity do you have?
Do you believe that you guys are going to be pressured by major companies with higher employment going to the feds and saying that, hey, you guys need to loosen up some of this tightness? Because of course, if I have gone through something within the past 3 to 4 months, one of my 5 C's are going to be out of whack. I mean,
right.
If I'm the Diamond Princess, the cruise line, right? JC Crew, they're kind of gone, right? You got JC Penney, that's another company that's kind of hurting right at this moment, right? You got the airlines that's kind of in a tough pickle. You have a lot of industries that the 5 C's are going to be out of whack. So
right.
they're going to come knocking on the federal government doors and reporting you guys and saying that banks are not giving us a break. And if I'm a public guy, wouldn't I say, man, I can't deal with this unemployment rate. I'm going to not get into my election year. I won't make it.
Right. So again,
pressure. Yeah.
I don't think we will get pressure from the Fed. Okay. I think the Fed is going to be doing more in addition to those 2 PPP loans. I think they're going to be doing more for businesses in general, just to, because we're not controlled by what the Fed said, right? We have our own risks that we're taking. We look at how to mitigate risk in addition as we lend this money, right? So we're not going to get pressure. If there's anything, I think there's going to be we're going to see a lot of effort from either the Fed, the SBA, to help, infuse a lot of liquidity back in the market. So people, as you said, companies that have, spotty, record on their, in their history will be able to get loans. But I don't think it will be a pressure from the Fed at all. But anything, it will be the Fed doing more so that we can help businesses more do better, right? And again, as I said earlier, this is why they kind of reduced the reserve requirement, right? So allow banks to be able to continue to service in these businesses.
All right. Right. Warren Buffett mentioned one thing, Anthony, that there's a big concern about the kind of money that is being dumped into the economy without productivity. Inflation. I mean, you're talking about $2 trillion, but there's not a lot of productivity, and the U.S. debt it's going up there. I mean, it's definitely over 50% of our GDP.
Right.
How do we even look at this and say the dollar is still going to be strong?
Well, I think it's a little pivot there, but we can go there. So
yeah, but I gotta add, yeah, man, this is focused on Liberia.
That's fine. I like that. I think we'll go into the economic piece of it, right? So with the the whole, as Buffett said, that is true. There's a lot of money being dumped into the economy without a lot of productivity. And the reason why he said that, because there's 40 million people that are unemployed right now, right? That is, depending on what number you want to apply to the population, right? It could be 11% or 12% of the entire population of the U.S. that's unemployed right now, right?
Yeah.
And we are just putting money in, like both PPP loans, right? The PPP stands for Payroll Protection Program, right? So that's money you're giving to businesses to keep paying their employees who are sitting home, are not doing anything, right? But we can't do anything if these people cannot work if the economy is not open, right?
Right.
And I don't think I want to worry about the inflation piece. I think the inflation piece, the Fed has been doing very well to meet their inflation target. So once this economy open back up, if that means they have to, I don't think they're going to raise rate, but they will do what they have to do to actually bring the inflation to meet the inflation target. But I think what we have to be worried about right now is the 40 million people that are sitting at home that are not working right now, right? How are these people going to eat, right? And if the economy even open back up today, not all those 40 million people will have jobs, right? Maybe a third of them will be called back to work. What happened to the other 3/4? It's going, that's what I said when people say this is going to be a V recovery. I said, you got to be kidding yourself. Those people that are going to take time to come back in the.
What is a V recovery? When you talk about a V, give it to us in a simple layman's term. When you
So
talk
V
about
recovery meaning that, okay, so I don't, you can see so we're here, right? We came down to the bottom, right?
Right.
And when things start opening back up, we go right back up, right? That's a V, right?
Okay.
So you here, you come right back down and you go back up. That's a V. Now a U recovery is like you're here, you come, you're going to stay at the bottom for a little bit of time, strike a little bit at the bottom, and then come back up, right? And I think that's what's going to happen. And that is contingent upon a lot of things. You know, there's the 40 million unemployment, consumer spending. With this thing that happened, what happened is that people are now holding onto their money, right? Nobody want to go out there and go splurge anymore, right? We're thinking about the next recession. It's just, if we're not already in one, right? I don't want to go spend money on useless things that I don't need, right? So people are holding onto their money. In as much as that is a good thing, that is a problem for the federal government because you want people to keep spending. If not, you need consumer confidence to keep the not just consumer, but on the business side as well to keep the economy going. So I think that's what we should be worrying about instead of worrying about the deficit right now.
All right, thank you. Let me come in. Stay on this issue of credit. Let's look at the borrower,
right,
and the creditor. Usually, the banks are the one who are the creditor. They give you the money, and you will receive the money. You are the borrower. So I want to have a better understanding here. The one who borrows and the one who credits, who tend to benefit more, and why?
Well, I would tell you right now, the creditor better. The creditor actually does benefit, the banks, right? So there's what's called the prime rate, the lending rate. So before we had this coronavirus or COVID-19, if you want to call it that. The fund rate was 5.25%, right? So 5.25, right? So if I lend money to you, that's the base rate, and I have to add what's called a spread. The spread, I mean, how much money I want to make, how much interest rate I want to charge on top of that. So if the interest rate is, let's say, 4%, and I add either 1.5% or 2% on it, that's how much money I'm going to be making. So the banks are the one that are benefiting from this. You as a business person, I think the way you benefit is by having a good credit score. If you have a good credit score, the better your credit score, even though it's not the sole reason why you get a better interest rate, but I think is the arch reason why you can get a better interest rate. If you have a good credit score, you're more likely to get a loan with a lower interest rate, right? And I think it's a one-way street, to put it that way. It's a one-way street for the only thing that we're doing to you is just helping you get access to loan so you can keep running your business and keep making profit and be able to pay back that loan, right?
So let's look at how it helps the entire economy to grow.
Right.
Because let me take you back. Many years back was barter system.
Right.
Money and credit were not in the picture, but now we have money and credit in the picture.
Right.
The whole idea of commercial credit, how does it actually help both consumer, the economy? I just want you to explain that for us to understand.
So, and I think that would take us into the economics piece of it, right? So whether you're a developing country, frontier market, or however label you want to put on that, right? Regardless of what country you are, small businesses, when I mean small businesses, I mean from 2-man operation to 500 employees. These are the engines that run every economy, right? And by lending to those people, the economy is just like what I want to call a well-oiled democracy, right? If you don't have a financial market, you cannot have a well-functioning economy.
Okay.
The two would just not work, right? So in order to grow your economy or have an economy, you need a well-oiled financial market. And I think that's that's what makes banking sector or financial market or capital market, whatever you want to call it, that's what makes it important. That's why. So the reason why I think the Fed actually step in to actually fund these businesses, right? If these businesses stop operating, that means they stop paying taxes, right? If these people stop paying taxes, you know what it does? I mean, the government is not collecting money to take on infrastructures and all those other stuff or pay the employees and all the other things that they have to do. So, as I said, it's a well-oiled cycle that has to keep going. So, if one piece of that bolt comes out, you have to plug it back in. If there's a hole that's leaking, you have to plug it back in. So that's just how the way I think you guys should look at it.
All right. And before I announce my phone lines, this one. So you borrow money
Right.
and the money is given to you. But
Mm-hmm.
before then, sometimes they ask you, you have to make a down payment. Why is it that at some instances, or maybe for a particular borrower, they
Mm-hmm.
will demand or request a down payment, but in the case of others, they will not request or demand a down payment. What are they looking at there? I know you talked about the five C's earlier, but what are they looking at there?
So I think that's more on the consumer side, and the reason that is it has to do with you know the if you're going as a consumer to borrow whatever amount to buy a house
Mm-hmm.
or um even on the commercial side,
Mm-hmm.
right? If you're going to buy a commercial property, right? We fund up to I don't think I should be saying this. We do up to 75% of commercial, right? Of
Right.
the value of the building, right?
That's the
So
percentage you finance.
right. So you have to bring the other 25%. So in that case, we will ask you to bring out that 25%. We call it capital injection, right? Equity injection, right?
Okay.
For the same thing go on the consumer side. So for most consumer loans, it will be maybe sometimes the FHA would do 90% or even 80%. So that means you have to come up with the other 20% or you have to come up with that 20%, right? So that's the reason why usually they'll ask for money upfront. Now, for some people, if the only way you go borrow money without them, banks asking for some kind of equity injection, that's if you're going for a line of credit, right? You're going for a line of credit. The line of credit, as I said, you run your operation, you just need this capital sitting there just in case you run out of inventory, you can go and tap into and go buy more inventory. That we don't need any, capital from you, right? We just go by the 5C. If you qualify, we give you that money as the money sits there. You can draw from it anytime you want. The same thing with, even if it's a term loan. A term loan, let's say you want to buy some equipment for your business, right?
Mm-hmm.
You come right to borrow that money. In some cases, we may not ask for equity injection in those kind of scenarios.
All right, so folks in cyberspace, you're watching Focus on Liberia. This is FOL Marketplace, a business economic forum where we talk about issues of economics and business. We are happy that you are following us here. Please, the phone lines are open for you to place your phone call and make a comment, or if you want to ask our guest a question, you can also do that. The number, as you can see, is right there on the screen, is 605-313-6004. Don't forget to enter that code. That is 791-403, and then you have to hit that pound. If you do that, you will have the opportunity to participate, to interact with us and also our guests. Again, your program is FOL Marketplace and the network is focused on Liberia. Here we educate, we elevate, we promote all things Liberia, and we are trying to educate on the commercial credit industry. That the people that give us the money, especially for business people, to do business. And so we are trying to get all the dynamics that play out in this particular industry. William, you seem to be enjoying this conversation. Any
Yes,
question?
very much so.
Yeah, any
Very
question
much
for our
so.
guests? Your turn.
Yeah. Hey, Gabriel, looking at where some of the things might hit the road. I look at, for example, Gold's Gym. I'm a member of Gold's Gym.
Yeah.
I haven't been there for about, 3, 4 months, right? And they've actually suspended payment of membership. They actually, filed for bankruptcy. But I assume that it may just be a strategy wise. But you're gonna have those type of companies. Now, tell me, is there any partnership, or how does a bank like you? How do you work with the private equity market or private capital market, or funds, in terms of, because you're going to have a lot of these folks that's going to be coming in to maybe shore up, or maybe to feel that they can salvage some of these entities. Do banks work well with? Do you think there will be more relationships now between them and private fund managers?
We don't have any um, kind of relationship with private equity firms.
Uh-huh.
I think that is contingent upon, you know, those actually companies being savage is contingent upon who their creditors are, right?
Okay.
If they have most of it depends who has first lien position to their collateral, right? So if you're
Right.
going bankrupt and I have first lien position to your collateral, if you sell whatever your assets, I'm getting paid first, right?
Right.
Now, if they had most of their debt to a private equity firm, those private equity will get paid. But as far as, the banks having a relationship with private equity firm or venture capital firm, no, we don't. We do not.
Right.
We do some startups. To be honest with you, I've had some startups in my portfolio, even some acquisitions. And that's because we were getting comfortable with doing. And that's the bread and butter for those VC and private equity firm. But I think banks were getting comfortable with doing that. But we don't have any direct relationship with the private equity or PE market. No.
Okay.
Yeah.
Okay. Good. Okay. That's going to be interesting, because what I see is for a debtor, is he just will a debtor be willing to look at the situation in from an overall perspective and say, hey, you know what? I think that a short-term payout may not be as beneficial to really digging into the trenches. I think we're going to see some kind of workout. I don't know what it's going to look like, but I think some debtors are going to say, okay, maybe can everyone sit tight for about 6 months? Because it does us no good to try to say we're going to sell this asset. This asset is going to be on the market for a long time.
Right. So that, to answer that question, right? So that's a good,
right?
Yeah. That's a good point you actually brought up. So when the COVID-19 happened, and I think I wish somebody could have talked to them to have them do a go gym. You go to, and that's all the businesses in my portfolio have done that, and that's what you're supposed to do.
What do you mean, Gold's Gym? You got your portfolio? You should be sweating, my man.
No, I don't have them. Okay. I'm saying they should have done that. You go to your bank or your creditor, say, hey, I need a modification. So modification meaning that you're going to stop payment for at least, if you said 3 months or 6 months, they're going to do that modification to suspend payment. So you don't have to make any payment on those loans. And I think they should have done that initially when that COVID-19 happened, right? At the beginning of, early March, when everything shut down. They should have gone back to the creditor, whatever is a VC firm or a PE firm or a traditional bank. They should have gone back to them and said, hey, we need a modification for at least 3 months or 6 months or however long they think this thing was going to last, to suspend payment. Now, again, as I mentioned earlier about liquidity, if they felt that coming out of this, they wouldn't have been able to come out, then you file for bankruptcy. And when you file for bankruptcy, if I have, assets, first lien position to all your assets, I'm gonna get paid first. So that's why.
Right. Anthony, one second before we go to the callers. Gabriel, what I really think is happening with some of the companies, while I'm going to speak to a company like Gold's Gym, I think that they may be deploying a certain strategy, because when when you go and you engage bankruptcy, everything kind of freezes. But that
Mhm.
doesn't mean that your operations stop, and that doesn't mean that you stop from making money.
Right.
It just means that like I can't just throw you out the building. I can't do certain things, and I think that maybe within that time span, what I'm thinking is that the company is saying maybe we can get back to some footing to go back to our creditors and tell them, hey, we understand what we did, but now our numbers are looking a little bit better.
Right.
And how can we come out of this, both of us, win-win? Because if not, they're just gonna fold on you.
Right. So that's going to be restructuring. It's your
Yes.
filing is not there's two type of bankruptcy, chapter 13 and chapter 11. Right. Maybe they're
Right.
filing for the restructuring part of it where
Yeah.
you just not paying your creditors and you're just going back to restructure the company, right?
Yeah.
Maybe that's what they're doing, right? Some companies are doing that. Sears, I don't know if you're aware of a Sears.
Well, I'm aware.
They did that before, right? They
Yeah.
filed for bankrupt chapter, I think it's chapter 13 or so, and it allowed them to restructure and come back. Like you said, it's a strategy to come back, hoping that that re-emerging will actually help them, go further. So maybe you're right. Maybe that's what they're doing.
Yeah.
But right.
All right. Let's go to some comments here. We have Musu Stewart writes, both sides benefit depending on what's involved. The debtor tends to lose if they are irresponsible. She's making her contribution there when I asked you the question, who tend to benefit more, or do
Right.
all benefit when a loan is given, the borrower and the creditor? And that's why she's responding to that. Yeah, both tend to benefit, but if the borrower is irresponsible, maybe they may lose, or even the debtor too. She said if they tend to be irresponsible, they might also lose. Please comment on that.
Yeah. So she's absolutely right. So I think, as I said, in that transaction, the bank has more leverage. So leverage meaning that it has more advantage, right? However, she's right. If that deal end up going south, right? I mean, the bank could lose, right? And again, this is why this is important to do your due diligence. Again, going back to those 5 C's of credit. So you don't just go through that. You want to understand the person to whom you're lending your money, right? You want to understand the person's character, right? You want to know that this person is committed to their business. They're going to run this business, So yes, but in some cases, regardless of how much due diligence you do, there are some cases where it just doesn't work. Like you are exposed to risk. You lose some deals. Every bank has a loss ratio, right? And you lose some deal. In those cases, sometimes the bank will lose. And again, it depends how you structure the transaction. I could put covenants in place. Say, hey, if this happened, I'm taking, whatever collateral you have. I'm taking first lien on your house, or I'm taking, all your business assets, or I'm, seizing your vehicles, everything, But in some cases, there are times where the transaction goes south and the bank can't even recover a penny, right? Because the person can't pay,
Okay.
So she's right, actually. Yeah.
All right, let's talk about interest rate. It's a huge part of the entire crediting, more so talking about the commercial, credit market. Interest, 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 interest. Interest can be
Right.
high, it can be low. So, few things. Why would a bank give me a higher interest rate and give William a lower interest rate? That's one. I know you talk about the 5 C's, but try to find something else besides those five and see what may also be a reason why they will give me a
So
higher interest
sometimes,
rate.
believe it or not, I don't know if I should. Relationships, people talk about relationships are very, very important, right?
Yeah.
So I could give William a lower interest rate because of the relationship I had with him. If I've had a long-term relationship, I know his business in and out. Sometimes I will even go to him and ask him, hey, how's the business going? And we would talk. So if I am his lender and I bring that deal to the bank, I would say, hey, listen, I know, traditionally this is the rate we're supposed to charge. But I know this guy, he's a great business guy. He's not just, his business isn't just within his community. He's actually somebody very effective in his community as well. The relationship you have with your lender is very, very, very important. So that, I usually tell people that regardless of what type of business you have, you need a banker. Whether you're using him or her or not, keep them beside you. Build that relationship, because time come for interest rate for you to get better rate. You can, if they come to you and say, "Hey, we're charging you 5%," you can go back and say, "Hey, let's drop this thing down to 4.75," right?
And Gabriel, quickly, let's say I took a loan from your bank
Right.
at 10% interest. I'm doing okay, but I'm still struggling. Can I come back to you and say, hey, Gabriel, the loan you gave me, the business is going, but things are still a little tight. Can we negotiate the interest rate, because I think it will help me? Is that something that has been done before?
Yeah, you can do that. It's possible. Okay. People do that all the time. But again, it goes back into the relationship, the type of customer you are. So it goes back to the relationship, the type of customer you are, and the type of business you run for them to be able to honor that request. Now, if you are to come back with that question, you know what that does?
No.
It allow me to go dig in your business even deeper. Okay, is this guy having a problem paying the money? Is that why he wants lower interest rate? So now I'm going to go digging. And if I find something there where you violate any of my covenants, now I'm going to lower it. I'm going to downgrade your business. If you had a 5 risk rating, I'm going to put it to either 6.5 or 6, because I know there's a problem. You're having a problem paying back this loan now. Yes, you can do that, but it will cause me to dig even deeper into your business.
And I have Jimmy Eastman here writing, is religion also used to discriminate? That's a tough one, right?
It is. I don't want to say yes or no, because it's a slippery slope question.
Maybe William can answer.
I don't think so. It depends the kind of relationship you have with the person. Now, no, actually, no. To be honest, no. We don't use that to discriminate. Honestly, no.
Anthony, when you walk into a bank, I think that definitely there are, like Gabriel said, there are certain levers, rules and regulations and guidelines and parameters that they are kind of confined to. But when you get into the private equity world and you get into the maybe private investments, right? Relationships is so key, and also in that space, yes, there can be quite a bit of prejudice in that area. But banking, they've done a lot of stuff to try to help remedy that. I mean, tell us, I saw, if I'm not mistaken, Gabriel, there's some community development part of your company, the community development work. Now, does community development come in for, do they qualify for a different interest rate? I see a lot of banks having something like that. The community development.
So we have a community development division as well, right? So you're right. Let me piggyback on that question that the person asked earlier. We do not discriminate on relationship, right? There's regulation that governs that, right? I told you before coming into portfolio management, I was in compliance, right? That's regulatory compliant. Those are the things that we track, right? Whether you ask for a loan, we have 30 days to respond to you. There's a lot of regulation, you had to follow it, and discrimination, it was actually one of them. We collect these data and give them to the government. They track all of these things. So if you are found to be discriminated on, because you have a better relationship with somebody, it could get your entire bank in trouble, right?
All right. We have a caller on the line, and after that caller, I have a special question for you that is so important to me, and I believe my audience. That one is juicy. I think William would like that. Let me bring in this caller.
All right.
Caller, your name and where you joining us from. Welcome to Focus on Liberia.
Good afternoon, Anthony. Thank you for taking my call. This is Musa Stewart.
Welcome, Musa.
Hello, Musu.
Hello. So I just wanted to make a comment regarding businesses and their failure during pandemics or disasters. Mm-hmm. What I've come to realize, especially in the United States, is that most businesses operate off credit. Mm-hmm. Businesses don't operate, their routine earnings are a mess. As a result, they've come to rely heavily upon the banks to give them lines of credit, which are mostly abused. And as soon as something happens, you have everybody running to the federal government for support. So I think if you remember what happened in 2008 during the market, during the crash, I think it was 2007, 2008, yeah, when Enron went bust and everybody else went bust. I mean, the Lehman Brothers, when people just became exposed. It showed that a lot of these big companies that we've come to respect aren't really managing their books the way they should. If there's a disaster, a company should have some sort of saving like an individual. You know, we talk about emergency funds. Mm-hmm. Most companies don't have emergency funds. Most companies operate day to day, going to the bank. They have a line of credit. When their money comes in, the bank takes their out and the rest goes to them. And most of what goes to them is not enough. So I think companies will begin to rethink how they manage disaster and pandemics when these times come. Because if they don't, look what's happening right now. A lot of people will be unemployed. Most people aren't going to go back to work. So it's a shame that companies will advertise heavily to get customers, but at the end of the day, they're not really managing the money. Then we, the consumers, come back as taxpayers to bail them out. So that's just my contribution for this afternoon.
Excellent.
Very, very excellent contribution there, Musu. Thank you so very much for calling in.
All participants are muted and they can unmute themselves.
All right. Gentlemen, sorry that I make that. So what she said brings me to this. Why? Before I ask that question I told you about earlier. It is important, that we have this unique understanding of what she just said. Let me use my company that I work for as an example, Southwest Airlines. Those of you who in the business world might have read about Southwest because Southwest appears in many examples about how well businesses are doing. Southwest has around $4 billion cash sitting down. It has been the culture of the company that there will always be bad days. So always save as much as possible. And that's why she was talking about the 2008 situation she talked about. That was when I moved to the US. I was confused what's going on. AIG, the auto industry, all these institutions were running to the federal government to bail them out.
Right.
So you would think that the institutions should be responsible enough to at least go through the tough time for maybe a year or so before asking for this handout, that they call bailout because they try to dignify it, but that's basically handout they get it. But again, it is the commercial credit industry. That's how vital it is, because if it is not there for individuals as well as businesses, I can just imagine that we will not have the economy that we need. So please chime in on that one, and I'll ask that tough question that William will enjoy as well.
Okay. I think that was a brilliant observation by the caller. Right. Yes, and I think initially when we started talking from the conversation, I mentioned something about the yield curve inverting, right?
Right.
So the reason that happened, because exactly as the caller pointed out, right? Mm-hmm. There's a serious problem of corporate debt, right? As she said, there's corporate debt. When I mean it was massive, that was one of the reasons why we thought a recession was coming. Because as I said again, there's cheap money, the interest rate was low, and these people were just taking out money, right? lot of debt, right? So with that level of debt, what's end up happening? Your what's called your debt to income, right? Leverage. Like you're so much in debt that the least mistake something happened to your business, you're gonna go bust, right? You're gonna go bankrupt. And that's exactly what was happening right before the the pandemic came. So it happened, it was a bigger concern in May of 2019, right? That's when the yield curve inverted. So the yield curve is an economic indicator.
Right.
So it means that if I lend you $30 for 30 days, the interest rate I'm going to charge on that $30 for 30 days is going to be lower. It's going to be higher than the one I give to you for, let's say, 15 days, right? So if the 30 days interest rate becomes lower than the 15 days interest rate, that's lower. And the reason that usually happens is because investors and economists usually predict that the interest rate is going to fall. So, and that was actually driven by corporate debt. There was so many companies that were, yes, they're operating, they're making money, but then, as she said, they're not saving enough money. So we knew that it was a developing problem that was happening. But I think the reason why we kept ignoring it, the economy kept ignoring it, or the Fed kept ignoring it, was because of the consumer confidence, right? The consumer confidence was high. The stock market was doing well. The job market was doing well. So we actually ignored that and said, because there's a lot of corporate debt, we don't care about that. There's these three other economic indicators that are doing very well. So that was a great observation that she pointed out.
All right. Well, hold on. We got another caller. I'm still keeping that question. Caller, quickly, your name and where you're calling from. Caller with phone number ending 6366.
My name is Desmond Finley. Anthony, how you doing today? And I'm calling from
Desmond,
Providence, Rhode Island.
welcome, my brother. How are you?
I'm well. Okay, it's a great show you guys are having. I just want to piggyback on what the last caller was saying, but what I want to infer is the fact that if you look at the economy in isolation of things, instead of giving a picturesque view, like looking at it in a big picture view, then you get to understand where things are. You understand the importance of debt. Debt is an important attribute if you look at the economy as a whole. For small businesses like to run on a daily basis, debt is a serious and intricate part of our economy, right? Because you need this debt. The bank needs to give a loan to have income to come in, right? So they need to finance stuff. So you have to look at it from the big picture view, as opposed to, if you look at just debt, you think the economy is bad. But debt is a key functioning part of the economy that makes it run. So, for example, Apple has $600 million in savings. That does nothing for Apple, right? It does nothing for Apple. But if Apple reinvests that money by buying it, that which happens usually, those things allow the economy to burgeon and go to a next step. So looking at debt, like she was talking about, running to this federal government to build. The federal government don't bail out because they like to bail out. But if you don't bail out, so you sometimes we factor in the lesser of both evils. You have to factor that in. If the federal government don't write a $2 trillion check for coronavirus, what's happening next? So it's not just a bailout in the sense that we're bailing it out because we like to get the money. Nobody likes to give people money. But you have to understand the economy is a big picturesque thing as opposed to one key or one hole one spoke in a tire chain. So that is something I want to point out. So debt is not really a bad thing if you look at it from the holistic standpoint.
Thank you. Maury, William, you heard that. He said nobody wants to give out money, but I know a guy, William King, he likes to give away money.
Yeah. Desmond. Man, I wonder if you and Gabriel, if they put you guys in charge of Liberia, what would happen?
Don't go there.
Guys at the bank, we're gonna be hurting because we got one side, our compliance banker, Gabriel, he's gonna be tough on us. And then Desmond is gonna say, hey, you know what, we need to get this wheel moving. But just an excitement time. It's just a good joy that we have Liberians in various professions coming together, sharing some of their disciplines. It feels so good. Anthony, what was the question you had?
All right. Yeah. Let me bring that question. But I really like Desmond's contribution about the positive aspect of debt. And
Yeah.
I may be able to make a $200 payment monthly, but I don't have the $15,000 for that car. I need to get to that job. And when I'm at that job, my productivity helps my company,
Yeah.
and my company overall portfolio helps the economy. The overall economy helps everybody. That's the trickle down effect of that. So I mean, I like that. That's one. It was
Hey,
good
hey,
you call. But before I ask my
Anthony,
question,
Anthony,
hold
Anthony,
on.
Anthony.
Yeah,
Wait.
yeah.
Do you realize the things you were saying and made Gabriel smile? Because that's what, when people come to borrow money, that's the kind of conversations they have with Mr. Gabriel.
He was. I mean, right on point. Right on
Yeah,
point. You know,
yeah. It was
as I
right on
said,
point. Mhm.
right on point. Yeah.
All right, before I ask my question, let me go to the live here and read a few comments here. I see two here from our man Jimmy Eastman. Jimmy writes, minority-owned small businesses tend to be hit the hardest by the pandemic's economic fallout. Early reports suggest that the upwards of 90% of the minority and women-owned businesses are not getting the relief loans promised from the government, he writes. And then also he wrote, historically, blacks have been refused loan as compared to whites, even when they have equal potential to pay. All right, that is there. But let me ask that question that I wanted to ask because we are coming to pretty much the end of the show. Desmond, please stay with us. I may have something for you to contribute to as well. Gentlemen, the question is for all of you. Desmond on the line, William, and our guest Gabriel. Gabriel, some time ago now, William and I had a show here on the same business economic forum. We have the technology guys. And that thing continues to haunt me today. Why can we not do this? And that is the availability of an internet infrastructure in Liberia.
Mm.
Those guys broke it down completely that if Liberia want to make progress, in terms of development, they need to invest in that particular infrastructure. And we have Lionel Bernard, who has a PhD also in technology. He based in Washington, D.C. He's a tech guy. And he said there was a study done in Liberia for the infrastructure to be built $65 million. And during the show, he said that even if the government is not willing to spend this money, if the government can write a proposal, identify somebody to implement the project, and send it to companies like Google and defend it perfectly and justify to Google how Google tend to benefit, Google can give that loan and Liberia can have internet because doing so will open a huge market for Google and other companies in Liberia. And I'm sitting there and then we don't have internet and we are here today virtually having a conversation that everybody learning from all because of internet. It would not have been possible. And so my question is, does your institution give money to governments? And if yes, what will qualify any government to get that loan? I think we didn't like that one.
Thank you. That is a great question. We have some government lending division, but we do not do we don't lend to other sovereign nations. Yeah.
Okay.
Unfortunately not. That's not something that we do. So I mean that would have been a great idea, but that's not something we do. No.
Well,
Yeah. So to your question that you talk about is really accessing the private capital markets. And so what that means, Anthony, is that there are wealthy individuals, wealthy companies like Google and so forth. Those are private entities, and they have more of the ability to step in and lend their own money or lend money based on what the shareholders decide, if it's worth it or not, like a social impact fund and so forth. To your point, Anthony, one of the other spaces, however, is the fact that it is possible that you may structure something with the internet that may look enticing to where once the ball is rolling, maybe after 2 or 3 years, that banks in general, that they see the kind of income or cash flow that is being generated. There are banks who might even be more willing now to then maybe just lend or be part of a consortium that would buy or pick up that business. So it's a more mature business. Our country, Liberia, from the developing side, it's always in the space of going after funds from entities that are willing to lend to developing business. But most from the banking side, most banks are mostly conservative in nature because they're dealing with money that's not their own.
Thank you. And Desmond, quickly, so we wrap this thing up.
Good question, though.
Yeah.
All right, so that's a great question, Anthony. The reason why I like it, I'm actually doing my master's in technology management as we speak. So what I would say to the first part of the statement that you made when you talk about the government now, what Liberia needs to do to write a proposal for $65 million, it all boils down to priorities. What are we prioritizing in our country for our country to be better? And it goes back to even the early government before this government. We are not prioritizing the things of today. We're not prioritizing the things of today because you're talking about a $65 million budget project to implement technology in Liberia to a certain extent that people will benefit at a huge scale. Government don't even need a loan for that. If that was a priority, that would be allotted and prioritized in the national budget to represent the future, how it futurely affect us as a people. Now, I give you this as a typical example. Talk about banking, right? There's a bank called Standard Banking. I think Standard Banking, and I'm not quite sure about the name, but the owner started his bank.
Stanbic Bank.
Yes, started his bank by going to market women and loaning them money because he realized the interest was greater with market women than in the traditional bank. He was making more money with market women. The only thing he had to do was have people consistently tell these market women to make sure to pay their money back. So he had to meet them on a daily basis. So that's the bulk of his profit margin today. Another form again, people use technology. When people use technology, as far as there are more people using mobile money on a phone transacting banking transaction on a phone that has never owned a bank account in their lives. The reason being is technology. But we haven't prioritized technology to the point that we think is important for us. So therefore, we will always lag, and technology advances exponentially. So if you're 10 years behind this year, trust me, next year you're 20 years behind. Mm-hmm. Actually, you're 100 years behind next year because of the exponential factor of technology. So we need to prioritize things and see where we need to put what's important to us as a country. Because you don't need a loan for $65 million to implement technology aspect like, but no, it's a budget. You can allocate that in the budget to represent your intent. And everybody said roads. I think roads are great. Roads are great, but roads don't travel faster than the speed of light. I'm just saying.
Thank you.
And that's my closing statement.
Thank you, Desmond. Thank you, Desmond. Thank you.
A juicy question.
Very juicy question. And those who might be wondering why I asked this question, let me provide that. We are talking about commercial credit industry. How is the engine of economic growth, especially for businesses, right? If a business is to move to Liberia, one of the ways most businesses reach consumer right now is through their website. And if you don't have a reliable internet, how will a business want to move to Liberia? The man who has a little business in Bokonjide, all right, maybe the man is producing palm oil. How does he advertise to somebody in the US who might want to buy in huge quantity? If internet is common, that man might say, oh, my business need is something, and then he has a little website, people can go and put in their order and he can supply them. Through that, that person can get linked to a much bigger business, and now he will have to be able to increase production. Overall, jobs are being created. The government is generating revenue, and Liberia is on the way to development. That is how it relates to our topic. Gentlemen, we couldn't have done this better. I want to say thanks to all, especially to our listeners, those who call and those who wrote comments. We appreciate you. This is Focus on Liberia. We educate, we elevate, we promote all things Liberia. Liberia must get educated on the issues that drive development and improve our life. And that's how we made our country better. Gentlemen, we got to close. Let me start with you, Gabriel. What you want to leave with us? Conclude on the whole impact of the credits, please.
No, thank you guys again for having me on the program. I think it was a great discussion. I think you guys did your homework. I've learned a lot from you guys as well. From all the questions. There's a lot to talk about in commercial credit. I think this was we just scratched the surface.
Mm-hmm.
But I think it was a healthy discussion. Maybe I look forward to being on there another time.
Good.
Thank you both.
All right, William.
Thank you. Yeah, thank you everyone for our listeners and people who've provided comments. It's I think there's a common thing that if you're a Liberian, you have a passion for Liberia, and every discipline that you do in the U.S. At some point in time, you think about how Liberia can benefit from it. At Focus on Liberia, we strive to promote, elevate, and educate all things Liberia. And what we hope to do and what we're achieving is just bringing some of our great talents that are globally and exposing them, exposing what they do. And Gabriel, we want to thank you for the work that you are doing. You're navigating through some very tough circumstances right now that no doubt is gonna make you stronger. So and it's probably gonna set you up for something bigger and better in life. And we just celebrating that success. So thank you once again for coming on, and to our listeners and viewers, thank you very much.
Thank you both.
And so, folks in cyberspace, on that note, this is how we will come to the end of our broadcast. I have been hosting along with Mr. William King, and we have had with us Gabriel as our guest. Gabriel is a Liberian. He came here and put in his time to be able to help us understand the entire commercial credit industry that is key to economic development. We all benefit from that industry as well, sometimes directly and sometimes indirectly, depending on where you are. And we are so thankful to him. Thank you for watching. This evening, we will have another show. We will be talking about the Islamic community having a Islamic holiday in Liberia. This is a debatable issue, and we'll be looking into that. Most of the holidays we have in Liberia, some people believe are Christian-related holidays, and we do not have one in Liberia talking about Islamic holidays. So we'll have 3% from the Liberian Islamic community that will be represented in this conversation. It will be juicy. Don't want to miss it. On that note, we want to say thank you and bye-bye.